All right, welcome back, everyone. Ready for another deep dive?
Always ready. What do we have today?
Well, today we're diving into a story that has everything. High finance, corporate drama, and maybe even a bit of a ticking time bomb.
Ooh, that sounds exciting.
Yeah, it definitely caught my eye. We're talking about Supermicro, or SMCI, for those following along with their tickers.
Supermicro, I've seen some chatter about them recently. It seems like they've been in the news quite a bit lately.
Exactly. And the article that really got me thinking was titled Supermicro, a Financial Bubble About to Burst.
A financial bubble about to burst. That sounds ominous. So what's the story here? Is Supermicro really in that much trouble?
Well, that's what we're here to find out. We're going to dig into their financials, see who's calling the shots, and try to figure out if this is a company on the brink of collapse or just hitting a rough patch.
All right, let's do it. Break it down for us. What did you find most interesting about the article?
So right off the bat, the article points out something pretty wild. The top three institutional investors in Supermicro, Vanguard, BlackRock, and State Street, they own like a combined 50% of the company's stock.
Wow, 50%. That's a huge chunk of the pie.
Right. It's like, imagine having that much control over a company's stock price. You could practically make or break them.
Yeah, you definitely have a lot of sway in board meetings. But isn't it kind of risky for those investors too, having so much of their portfolio tied up in one company?
That's exactly what the article dives into. They call it a wait-and-see game. These big institutional investors are basically stuck.
Stuck? How so?
Well, if they sell off all their shares too quickly, what happens?
I guess it would trigger a sell-off, right? Everyone else would panic and try to dump their stock.
Exactly, and the price would plummet. But on the other hand, if they hold on to the stock too long and Supermicro really is in trouble, then they risk losing even more money.
So they're caught between a rock and a hard place. It's a tough situation for them, but it sounds like it could be even worse for everyday investors who might not have the same resources or information.
Definitely. It really highlights the power dynamics at play, right? These institutional investors have a lot of influence, but it also comes with its own set of risks.
Absolutely. So what else did the article reveal?
Okay, buckle up, because this is where it gets really interesting. The article talks about Supermicro debt.
Debt. How much are we talking here?
Well, they've got this loan, right? Started out as a $700 billion loan, but by the time they pay it back, it's going to be more like $1.4 billion.
Whoa, that's more than double. How does that even happen?
Apparently, they were from renegotiations, higher interest rates, and even a 5% premium tacked on. It's like borrowing a pizza and having to pay back with two pizzas and a side of wings.
Ouch. Yeah, that's not a good deal. So where do things stand now with their total debt?
Get this. Projections in the article suggest their total debt could balloon to, get this, $8 billion by 2029.
$8 billion? How can a company even manage that much debt? That's an insane amount of money.
Right. And that's not even the worst part.
There's more. What else could go wrong?
Remember those big institutional investors we talked about earlier? Well, it seems like they aren't the only one getting a little skittish about Supermicro. The article also mentions some of their biggest clients, like Amazon and even Elon Musk, are starting to look elsewhere for their tech needs.
Wait, they're losing major clients like Amazon? Isn't Amazon like everyone's biggest client these days?
It seems like it, and the article specifically mentioned the going with competitors, companies like Dell and HP.
So if you're Supermicro, you're dealing with a mountain of debt, and then your biggest clients are suddenly going to your rivals.
It's not exactly a recipe for success, is it?
Not at all. It's a classic 1-2 punch. It makes you wonder how they plan on generating enough revenue to service their debt if they're hemorrhaging clients.
And that's a great question, and it kind of brings us to the most surprising part of this whole story. Because despite all this, the article mentions that there are some investors out there who actually see this as an opportunity.
An opportunity, really. Who in their right mind would invest in a company that seems to be on the verge of collapse?
Right. It seems crazy, but apparently there's this whole group of investors who are all about high-risk, high-reward situations.
So they're basically gambling on a comeback story. What is their game plan?
It's all about timing. They're hoping to ride any short-term price fluctuations, maybe snag some quick gains if there's a bit of good news or a market trend that pushes the price up. But the goal is to get out before the bottom falls out.
And by bottom falls out, we're talking about delisting, right?
Exactly. If Supermicro gets delisted from the stock exchange, that's a pretty clear sign things aren't going well and the stock price is likely to tank.
And for anyone who didn't sell their shares in time, they're left holding the bag.
Right. It's a risky strategy, no doubt about it, but for those who can time it just right.
Big rewards, potentially, but that's a big if. Delisting can be a death knell for a company, right?
Yeah, it pretty much signals to the market that a company's in deep trouble. It becomes much harder to buy and sell their stock, which usually means the price takes a nosedive.
It's a reminder that investing always comes with risks, especially in a volatile industry like tech.
Couldn't have said it better myself. So for everyone listening, what's the big takeaway from all of this?
I think the biggest lesson here is that even companies that seem successful on the surface can be facing serious challenges behind behind the scenes. It's a good reminder to do your research, understand the risks, and maybe think twice before jumping into any investment based solely on hype or speculation.
Solid advice. Knowledge is power, folks. And that brings into our final thought for today's deep dive. If a company like Supermicro, with its big-name clients and history, can find itself in this precarious position, what does that say about the stability of the tech industry as a whole? Is there a bigger bubble waiting to burst? Something to think about. Thanks for joining us on this deep dive, and we'll catch you next time.
See you then!